Hi, everyone. This is Rosie Hayer and Brittany Daly, and I'm going to let our guest speaker be disclosed in a moment. With Rivet Real Estate, we are thrilled to be here with you guys. As you can see, we are committed to make sure you guys stay ahead of the curve, regardless of what real estate market and economy is throwing at us. So let's be honest with ourselves. Everybody's reading on Fox News, CNBC, everywhere. The interest rates are going up. Inventory is going up. Is market going to crash? Are real estate prices going to drop? What is the opportunity in today's market for a home buyer and a home seller? So today we wanted to bring you a very unique opportunity in lending that was not available in last 2-3 years, but it is now becoming available for you to utilize so that you can make sure you are able to take advantage of the prices that didn't exist in last 2 years. As you all know, in last 2 years, we have been famous in Austin, Texas for multiple offer situation. When I say multiple offer situation, I mean, you gotta go through 21 offers just to acquire one home. And once you got that, don't forget writing those $60,000, $70,000, $80,000 above market value checks that never amounted to anything but just a simple equity in the house that didn't do anything for us. So if you were an investor, this was a very tough time period for you. Now, as the inventory is picking up, there's a unique opportunity for you guys to enter the market and grab your unfair share. Now, the biggest obstacle we are running when we run numbers on paper for our investors and buyers is the monthly payment, because interest rates literally went in April from lower 4.5%, 5% to 7.75% now. This is the largest hike our country has experienced since May of 1994. So today, without any further ado, I would like to introduce our lending partner, Sharon Barney, who has been so creative in coming up with innovative ways for our investors and our primary home buyers to lend money. Because we all know our real estate purchase is heavily dependent on how lending works for you. So Sharon, take it away. I would love to hear from you, all the great things that you have been sharing with us off camera and share with our people today.
Absolutely. Thank you so much, Rosie. It's such a pleasure to be here with you today and to be able to talk with your clients and those amazing clients that you serve. So my name is Sharon Barney and I'm with CMG Financial. I'm a branch manager and loan officer here. And yes, one of the great reasons that I'm here at CMG is that we have a proprietary product, loan product. This product was actually developed in 2005. And right now, as you mentioned, with the market the way it is, with rates rising, there are a lot of people waiting, sitting on the sidelines. Granted, there's a ton of opportunity that really it's a great time for those people who are in a place to be able to take advantage of it. So we have an innovative product for you to be able to have access to some of that, meaning, you know what, interest rates and those things, we don't have control over that. Hey, I don't, we have no control over what's going on there. But we can have access to something that maybe isn't so interest rate dependent, and that will truly give you some flexibility. So I'm going to do here is I'm going to do a screen share to start and show you, show you about our all-in-one loan. So the all-in-one loan, as I had mentioned, was pioneered in 2005. Now it became available in Texas in the last year for our Texas homestead properties, but it has been around and is a vetted product. In fact, this type of product it's new to the United States, but it's something that people in other countries have utilized. And it gives you the ability to pay off your principal balance significantly faster than a traditional loan, and really save generate tens of thousands of dollars in saved interest expense, and without changing your monthly budget or anything like that, and without increasing your minimum monthly payment obligation, and without, the biggest part, relying on interest rates movement. So I want to talk a little bit about, to start, the traditional loan. So everyone knows what the traditional mortgage loan is. I mean, no one will ask me questions about exactly how much an amortization works or anything, because most people, we understand, we get it. And most people, they kind of just have come to terms with the fact that with the traditional mortgage, we're going to pay most of our, those payments that we make every month, most of that is going to go to interest in the first 10 years. So as an example, on a home that's 625,000, we have 500,000 financed on a 30-year fixed rate mortgage, you're going to pay 258,000 in total interest expense. Okay. So that's a 52% interest to principal. And the total payments on that, 658,000. So you're going to pay, your total payments are going to be more than the price of the home that you originally purchased. And the positive things about traditional mortgage is that, maybe for a first time home buyer, it's going to, people with, maybe lower positive cash flow, passive income earners, unestablished savings habits, those type of things. But a traditional mortgage it's very slow. It's going to take a very long time for you to pay that down. The interest is front loaded, it's rigid. There's no access, right? Like if you've gained equity in your home, if you want access to that, you're going to have to refinance. You're going to have to take those steps in order to have access to anything. It's just very,
I just want to take a moment and really highlight the word rigid.
Yes.
Could you please explain to everyone again, what does that rigid means? Like, why is a traditional loan rigid versus the one that you're going to be sharing is not going to be rigid?
Right, because it's an amortized loan. There's not much that those terms are set until you refinance. That interest amount, and that's going to be for the life of the loan. Nothing's going to change there until you do a refinance, pay those refinance costs, things like that, to take money out of that home. But
so basically, you're saying that if I have a $300,000 property and there's a $200,000 loan and there's $100,000 equity in the property, the only way I can take my equity out is if I refinance the property, and at that time we would be subject to the interest rate of the market at that time. And how much can we really take out? I think 75% of ARV.
Right. So on an investment property, right, 75%, given depending on how much, you have financed on that home, whatever available equity, right? Okay. Yes, that's exactly. And that's a great point. That is exactly what I mean by rigid. And yeah, so it's not something, and you're also exactly right that we would be subject to whatever the interest rate market is happening. And it's interesting because especially in Austin, right, we talk about how much, like, people get so excited because of so much appreciation in our homes. And we talk about, oh my gosh, my home is, now worth, 50% more almost in some cases. And yet, what does that really mean? Because can you see, like, where is that cash? If that's in your home, can you show it to me? Yes. What is it? So that's exactly what we mean by rigid.
Thank you. Thank you for explaining that.
Absolutely.
Guys, this is very important that you understand that, because a lot of people come to us and they say, I have equity in the house. And Brittany, how many times we're not able to do anything with that equity, right? Yeah. Like, if you cannot reach your equity into your home and pull it out to buy another property or reinvest again, that equity is only good for the house that you have built and you're paying mortgage on, but it's not good for anything else.
Yes. And to that note, for many people that I talk to and meet, when it comes to time when they're all of a sudden see a great opportunity for investors, or when it comes a time when they need those funds, it's usually in a little bit of a hurry. And it takes some time. It's going to be a 30-day process to get a cash out refinance. It's going to be costs, those type of things. So yeah, there's definitely a better way to do that.
Okay, very good. We're all here. Thank you.
Yes, and traditional mortgages, of course, are very expensive. Hey, and I'm not talking all bad about traditional mortgages. I also still do traditional mortgages. I do 30-year mortgages, and that may be right for some people, like we say, right? But there's definitely a better option out there. So on an all-in-one loan, we call it the AIO. It is a 30-year open-end mortgage, and we have really separated the principal and the interest portion of from a traditional mortgage, where when you make your payment, that goes to your principal interest. And we determine on a traditional mortgage how much of that is going to interest based off of an amortized schedule. Now, on the all-in-one loan, that is separate. So your payment, your true minimum payment, is going to be an interest-only payment. And the interest-only payment is going to be calculated off of the daily computed interest off of the principal balance. Now, what does that mean? That payment, by the way, is going to be due on the following month on the 21st. So it's different than how we, usually do mortgages. If you have one, it's always on the 1st. But what that difference, though, is that the interest is calculated daily. It's very different than on an amortized mortgage. When you have access to pull out 30 years, when you do the all-in-one loan, the principal portion is fully controlled by you. It will be linked to a sweep checking account. And that sweep checking account, every time you make a deposit into the sweep checking account, 100% of that gets applied to your principal balance. So that's the interest and the principal portion. That's huge for investors because, as you know, like we said, right now with, rising costs and interest rates, for investors, I know a big part is, how are we going to cash flow right now? So for that, your minimum payment is going to be interest only. And then if you decide, depending on what your goals are, if you decide that, your goal is to pay this off as quickly as possible and have access to your equity line, you can do that as well. You can put that towards your principal, and that will immediately decrease the principal and in turn decrease the amount of interest you're paying. So on the all-in-one loan, you do have access to the equity for 30 years. The way that it's done is for the first 10 years, you have access, free draw access. After the 10 years, the line amount starts to get reduced over the 30-year term, so that, of course, if you were to keep the loan, and by the way, the payoff on the all-in-one loan is about 11 years for most of our borrowers, because of how quickly these are. Now, we say pay off, but people pay it off and they use it again, pay it off, use it again. And you can also refinance, just like you refinance your normal loan, as the values of your home increase and you want to increase the line or continue to have more availability to your line. But if you were just to keep it for 30 years, the way that we make sure that by the end of the 30 years, you don't have a balance at that very end, the line is reduced after the first 10 years. So that reduction, the way that is calculated is, we divide that by 240 to get to the end of the 30 years.
Sharon, I have a quick question.
Sure.
So you mentioned that the people are on average, it's taking on average about 11 years to pay it off if they were not tapping into the equity, correct?
That's right. And that's really, that data is over, primary and investors. So, for investors, they'll likely use this product a little differently, but yes, for most people, if your goal is to pay it off, that definitely is achievable, and you have the flexibility to do that. But yes, you pay it off and then you use it again, right? And then you pay it off. So it's definitely a financial tool that you would be able to do that. So in the case of an investor, you could pay it down, buy your next property, pay that one down, use the cash, so on and so forth. It's a incredible tool that can be used. So some highlights, on the all-in-one loan, there's no balloon payment or prepayment penalty. Again, it's flexible, it's open end, provides 30 years of draw access, allows for loans up to $2 million. Can be used for purchases and refinances. So for those of our investor clients that currently have a traditional loan, and you want access to some of that, we can go ahead and get it set up that way now, and you'll have access to cash in hand now, plus any additional equity will be available to you. Applies to primary, secondary, and investment properties, single family as well as multifamily. We go up to 1 to 4. So that some basic requirements on the all-in-one. Again, this is for someone who does have some cash flow, who is somewhat financially savvy and understands their finances. It is on an investment property, it's a minimum of a 720 minimum FICO. On investment properties, it's a 75% loan to value, and for the debt to income ratio, 43%. We require about anywhere from 10 to 15% in reserves for your line amount. Yes.
I have a
Rosie.
question, Sharon. For the investment properties, does the property have to be rented for that loan to occur?
No, not at all.
Guys,
No.
this is a huge benefit. Traditionally, when investment cash out refis were happening, they had to provide a proof of a lease agreement with a proper security deposit and first month's rent coming in. But in contrast, the AIO loans are allowing you guys to pull out 75% of the cash from a property without needing any lease, because they understand that the loan is so good that over time you will pay your principal down. Now, there's one thing I do want to highlight here is traditionally when we get a mortgage that is a principal, interest, tax, and insurance mortgage, right? That's the monthly payment that's included in it. Even for those mortgages for first 5 years, Sharon, in your experience, how much principal is really paid down?
In the first 5 years?
Yes.
Oh, I mean, barely any, very, very little.
Very, very little, right?
Really, even for the first 10 years. Yeah, but it's 90% of it is going to interest.
Thank you for saying that. So if a traditional mortgage is basically interest heavy for first 5 to 7 years, and hardly any principal is being paid down, why not make it interest only all the way and at least ride this high interest rate trend of the market? And in 5 years, let me ask you a question. If somebody wants to say, you know what, I'm done paying the interest only loan, I want to refinance because the interest rates are back down to 3-4%. Would anybody get in their way of doing that? All right, well, I think you have really evidently showed people how an interest-only mortgage is much more beneficial than a traditional mortgage when we're paying interest all the way for the first 5-7 years.
That's such a good point, Rosie. That's why you're the boss, because that's exactly right. Interest is hidden, right, on a traditional mortgage. It's hidden. We don't even see it. We just make those payments every month, and it's like, okay, what are we doing? And you look, people don't even want to look at the amortization table because it's like, what am I even doing? Nothing is moving. But on this, it's completely, you can see it. You know exactly what's going to interest, and you know exactly how you can apply your principal if you want to do that. You have the full control over this mortgage. And that's why we say it is for someone who has a good sense of their finances, because you will want to, want to have the ability to go in there and control and be able to understand that part. But that's exactly right. Yes. So yes, it is for someone who, has a good cash flow and things like that. So yes, you don't have to be, it doesn't have to be rented out. But what we see is that I've done simulators in the past, and what we see is that when you apply that rental income towards the principal balance, it's going to go a lot longer way than on a traditional mortgage when you're just, making those payments. So on the term options, now for the investment all-in-one loan, we have the options are a 3-year fixed and a 1-month adjustable. What we see, interestingly enough, about 80% of our clients, especially investors, prefer the 1-month adjustable. And I think that's because most people, our investors are savvy, and they know that, this market is moving, and we have our ups, we have our downs. And right now, of course, we're up. However, when we have our downs, you also get to take advantage of that. The rate, of course, is not amortized, so it's very different in the way that it's calculated, is adjustable rate. So the 1-month adjustable is a monthly adjustable off of a CMT index. The CMT index is a 1-year treasury. It's historically very stable, one of the most predictable indexes. So there is a max, there's a cap, and things like that. So the rates are very, very competitive to conventional mortgage. So right now, with the way that the market is with traditional mortgages, it's almost a no-brainer because the rate is lower on an all-in-one, even on the adjustable rate. If you were just going to look at the rate, because it doesn't compare the same way, the all-in-one rate would have to be much higher to compare because of the way that it calculates, because it's not amortized, it's on a daily computation. So
I have a question, Sharon.
Yes, sure.
In the event that, let's say they wanted to do the 3-year fixed,
Mhm.
would they be able to buy the rate down? Or is it just is what it is?
No, the all-in-one fixed rate is going to be, there's no buy downs. We have an all-in-one rate sheet because it's not going to go off of the market like we do on a Fannie Mae or Freddie Mac loan. This is a privately secured loan. So we will have a rate sheet. We'll tell you based on that. It does also change depending on where the market is. So based on when you lock, it would be locked in at that rate. You get an introductory rate for the first 3 years, and then thereafter it becomes adjustable once again. Mm-hmm.
If we do get an adjustable rate and we feel like, you know what, interest rates are going up, can I change it to the fixed rate and refinance it?
You can refinance, but it would be either adjustable or fixed from the get-go, from the time your loan closes. Mm-hmm. I mean, you know, even now we're seeing that likely, you know, I don't have a crystal ball, but likely that rates will shift downward in the near future. And so, you know, you'd be able to take advantage of that if you're on adjustable. There are simulators that I could run depending on, you know, each client's kind of how they would use the all-in-one to show them which one might be the best. Some of it is based on preference, right? So the all-in-one loan, as I had mentioned, is linked to a sweep checking account. This checking account you know, has access just like any other regular checking account, online banking, check writing, access ATM, you know, debit card, it's FDIC insured, all of the things just like your normal checking account. But hey, we're not in the business of selling checking accounts. We don't earn anything on the checking account. This is just a tool as a sweep for the mortgage. So this is linked to the mortgage, and every time you deposit into the account, it automatically hits the principal balance and decreases that balance. And as nightly, that interest that's computing is off of the principal balance. So imagine if you have, some people are using it this way, is they set, you know, idle funds or monies, you know, not money that are invested, but monies that maybe are just sitting idle in a savings account to mitigate, you know, any incidentals on your rentals or to, you know, things like that. If it's just sitting there, you can use those funds, let it sit in the all-in-one principal balance so that you're paying less in interest. And then if you need those funds, those can be withdrawn at any time. You have access to it 100%. So that is one way that a lot of our borrowers are using it. So this is just, you know, letting you know, think of it as any, you know, regular income or savings. If that's how you wanted to use it, you can. For investors, rental income, if you want it to just deposit in there and then have your, you know, expenses for the property come out of the equity, you could do that. This is just, again, for more so for primary, if you have expenses that come out, you know, this, you can apply all of that. The all-in-one interest calculation, again, it's calculated on daily interest, you know, automatically. For a lot of our investment borrowers, by the way, you don't make a payment. On your interest-only payment, it just gets taken out of the line. So you don't actually ever make that minimum interest payment. It just comes out of the line and sweeps itself.
Got it.
It could essentially just be, you just have no mortgage payment. And then you have access to that. So every month, automatically on the 21st, it sweeps from the available line to make your interest-only payment. It pays itself. So that's pretty much all I've got for you there. A lot of these, you know, talking about banking activities and savings, I think for a lot of our investor clients, you know, it's something that you can use, but for people who've used it and understand it and have access to it, we're seeing that people are starting to use this as like their primary checking because they want all of those funds that are coming in to help them reduce their interest cost. So, but that's pretty much what I have there for you on the all-in-one loan. What I would say is that, you know, for anyone out there who's interested in looking at more and seeing how it can help, I would love to run simulators for them based on their exact properties and to show them, you know, how this can be used as a financial tool to really help build their.
I think it would be a fantastic opportunity that we would do a follow-up call where we will run true scenarios of investment properties. Like if somebody were to buy an investment property with a traditional mortgage in today's market, what would be their monthly payment versus if we use the AIO loan, what their payments would look like. Because Bree, I would love for you to share with us on some of the challenges we have been able to overcome for our investors who were sitting on equity and not sure on how to proceed. Would you share with us?
Oh, like one of our clients who was utilizing the AIO loan?
Yeah.
Oh yeah, Sharon, let's talk about that one client that we have who has a couple of different properties, and he wasn't able to sell them right now. He has tenants that are living in them. They're paying good rent. He has low interest rate on them, but he needed the cash for some other things that he wanted to invest in. And I believe, Sharon, you can kind of talk more about this than I can, but he's utilizing the AIO loan, doing refinance on them so he can take out some of the cash and have access to that equity right away.
That's exactly right. Yes. So on our mutual client, yes, he has these investment properties. Now he put a lot of cash into them. A lot of his assets are in these properties. He got them at it was a great opportunity. And so it was a really good time for him to do that. I think it's going to be similar to a lot of our clients right now, who there's a lot of opportunity out there. Now his the equity, or, a lot of that stuck in the home. He has traditional mortgages. All of the mortgages are traditional, of course. And we're looking at this like, okay, now, so that he can have access to some of that, what are we going to do? And what if there's another opportunity that pops up? For investment properties in Texas, we can't do a home equity line of credit. And so his only option would be to get a full cash out refinance, which is going to take 30 days, have more costs, those type of things. We looked at an all-in-one, and by the way, it's going to save him so much money. We can now, first of all, give him cash in hand. He'll have access to that equity. He'll also have access to the line as he pays back, any of that, the cash out that he's taken. He'll have access to the line so that in the event that there is another opportunity that comes up, he can have access to those funds to purchase another property quickly, in a hurry. Something comes on the market and Rosie says, let's go, he goes. And so that's one. The other part is now a lot of his assets are being leveraged. And the really amazing thing about the all-in-one is, so on the all-in-one, you do have to have reserves, right? You have to have 10, depending on your debt to income ratio, maybe 15% in reserves on the total line. So we're talking about if we want, a $500,000 line, we need to have at least 50,000 in reserves. So on an all-in-one, you have the one existing all-in-one loan, and now we can actually use the equity on that existing all-in-one loan as reserves for your next all-in-one loan. So we have one, right? Then we can use the access we can use the equity, and we can use that as reserves for your next one.
Wow.
I think
so he doesn't have to get rid of the real estate, right, Bree? Like we were thinking about
getting rid of it.
Like imagine, guys, you all are thinking that I have to sell the house to get the equity out. What if we think creatively and optimize our current assets and enable ourselves to buy more property by simply using AIO loan? And by the way, guys, if you have an extra $1,000 cash flow from those duplexes that we are showing you, and you want to pay your principal down, nobody's going to get in the way of doing that. And if you win a lottery, which I hope you do, and you decide to pay it off, Sharon, is there any prepayment penalty?
No.
So Bree, I would love for you to share an example of one of our primary home buyers who are taking advantage of an AIO loan. Guys, let this sit in for a minute. So Bree, take it away. Tell us everything about the primary home buyer.
So we have a buyer who they own a current home and they're going to be selling it. And they were actually paying a lot of additional principal. They would get big bonuses, put all of that money towards the property. And we told them, this was before we even knew about AIO loan. And we told them, hey, stop doing that, save some money, right? So that way you can buy investment properties. They ended up, we're buying the primary first because we found the home that they love. We are utilizing the AIO loan on the primary home. These people, when I say they've only owned their home, Sharon, maybe like 5 or 6 years.
Like 5-6 years, yeah.
And they have paid it down to where they barely owe like 80,000 or something. If they were able to do the AIO loan back then, they would have had all of this cash sitting right there where they didn't need to sell first, right? And they don't need to sell first, they're good, but they're utilizing this. They're going to pay off their over $1 million home probably within 7-8 years, you know?
Yeah,
Who can say that? Who can say that?
Nobody. Guys, this is unique. This is very unique. To have an interest-only loan on a primary home isn't something that has been heard of. So,
Can I say one thing, Rosie?
yeah, please.
And you know what's really interesting about that is this is a great tool for people who, number one, if you're already an investor, great tool to utilize. Number two, if you're someone who maybe you don't have these cash reserves or you can't save that 20-25% every year or every 2 years to buy an investment property, but you can start this with your current primary home, do the AIO loan, and then utilize your equity to go out and build your wealth through real estate. This is the tool that we've been waiting for the past 7-8 years, right? So this is it's a really great time to utilize that tool because now we're actually able to negotiate on the buying side.
Yep.
Yeah. And can I add one more thing in there? Because we're just getting so excited. For your clients, yes, they were in a position where they had enough assets and cash flow to where they're able to just, qualify for the 2 mortgages, buy the new one. Now they're getting an AIO loan. There are borrowers out there who they're not going to immediately qualify for the 2, and they need access to the cash. They need access to the equity, right? So for a primary homeowner, had they had, like, let's say if they were in that position, had they had that all in one, they can take the equity out of the home, put it to their purchase, and then rent out that existing home. They can become an investor and a primary borrower at the same time and but that's why it's a financial tool, because they would have the ability and access to that. But with a traditional mortgage, they're not going to be able to do that because it's going to take 30 days. They're going to have, so it's just not going to work that way. But yes, I'm so very excited to share this with you.
I have one question for you, Sharon, because I know our investors who have purchased in the past couple of years who have that crazy low interest rate are going to ask this question. Even though I've gotten a 3%, a 3.5% interest rate on a traditional mortgage, is AIO loan something that I should be doing? This is the question that they're going to ask. So I'll let you answer that.
Yes. And the short answer to that is yes. And for those people, I would say, come talk to me. Let me run a simulator for you because you have to see the numbers for yourself. It is just not the same thing. Even if you have a 2 or 3% interest rate on your mortgage, the way that you're paying, you're still going to pay much more to interest. The interest expense is just going to be higher. If you did the same thing with an all-in-one loan, because of the way that it's calculated, you're going to pay less because of the time. The time that you're going to be paying interest is going to be much longer, which at the end of the day, you're going to be paying much more interest. And that, the interest, everyone's, similar is going to be a little bit different depending on how their payments look and, what their, how their activity is on the all-in-one checking account. But, and I can share a quick example, just real quick, because I know we're, this all-in-one simulator that I had done for a client recently. This is a simulator that we just did on a purchase price of, this was on a loan amount of $500,000. And we did exactly what they would have paid on their principal and interest payment on the traditional compared to an all-in-one loan. And they were going to be able to get that paid off in 10.6 years. So interest over time, you're going to be paying more. So in this scenario, this is kind of the example of what that would look like on an all-in-one simulator, and I would share that with them. But yes, it's just not calculated the same way. And besides, when we're talking about flexibility, control, access, a financial tool, those things, just that right out of the bat, being able to have cash flow, interest only. Okay, you have a 2% interest rate that's stuck on this, long-term thing. it's not really comparable, to be quite frank. I hope that answers your question.
That did. And you know, and everyone that's watching, I want y'all to really hear that I wanted to answer that question for y'all. You heard it here, right? Go ahead and talk to Sharon, talk to us, reach out. We'll run the numbers for you and show you how we can truly compare it and what's going to be in your best interest.
All right. Well, thank you so much. You guys have really poured in some demonstration of great examples and some out of the box thinking. So guys, here's the thing. The easiest thing is to do nothing. But if you are able to just open your mind and look at 1 degree different angle than where the rest of the world is headed, every opportunity is knocking on your doorstep. So lending is a big part of what enables a buyer or investor to enter the market. And our job as real estate professionals is not to just sit on the sidelines and wait for market to shift and change directions and then tell you what to do next. Our job is to stay ahead of the curve so we maximize the current opportunity for you and show you something that is not available to general public. So guys, if anything we said today interests you and you would like to take this conversation further and take the equity that is non-living in your home and make it a living asset for you, call us today. We'd be happy to run as many simulators as you want, as many comparisons as you want, because after all, we only want you to do something if you feel completely confident and comfortable. This is something I personally will vouch for, and this is something I personally would experience with properties I would own. So we wouldn't ask you to do something we wouldn't have done for ourselves. So I highly recommend, if nothing else, give it a shot, give Sharon a call or give us a call. We're happy to set up a beautiful Zoom call for you. And we will run simulators and comparisons so that you know how much more stronger you are asset and cash wise than you might be thinking. So guys, until then, make it a great day. We look forward to making your real estate portfolio rock. This is a great opportunity, so don't miss out. Let's act together. Have a great day.
Bye.
All right. Thank you, Rosie.
Thank you.